Morning everyone, welcome to today's webinar. So for today we have, as you can see, we have quite a number of company results update, and we also be presenting on our monthly recession trackers for US technicals. So without further ado, let's look into our first company update. We apologize that our analyst covering the energy and commodities is not around today, so I'll just briefly go through the slides for him. So first off, we have China Aviation Oil. So for China Aviation Oil, his call remains on maintained on buy with a target price of $2, and the growth driver remains intact as he expects the Pudong airport to deliver strong earnings growth for CAO in the upcoming years. Next, we have China Everbright Water. We maintain a buy rating with a target price of 60 cents. So for China Everbright, we think that the target to ramp up daily design capacity is still on track, and this will provide a positive outlook for the counter. As for China Sunsine, we maintain a buy call with target price of $1.60, and as the main investment thesis remains intact, where we expect that the market consolidation to continue in this year. And as for the cost side, we are seeing that both raw material and rubber chemical prices are expected to remain high and being able to pass to customers. As for CNMC Goldmine, we upgraded our call to accumulate with target price of 30 cents. So for CNMC Goldmine, the positive factor would be the resumption of the uptrend in gold price, and we look forward to its significant turnaround of gold output stemming from the replenishment of high-grade ore and higher gold recovery. So that's all from the energy and commodity side. Next up, we have Raffles Med. So for Raffles Medical, as you can see that the top line as well as the bottom line are flattish with 1% growth year on year. So this is actually being supported by the higher local patient load coming from the hospital services side. And we are also seeing a higher rental income coming from the fully leased Raffles Holland V. So do note that for this year, we have some changes in the fair value of investment properties as they convert some of the Raffles Specialist Center from investment properties into their PPE. So that actually recorded some gains. If we excluded that, you can see that the bottom line actually contracted slightly by 1% as well. So for this year, we expect that the expanded capacity in the Raffles Hospital as well as Raffles Specialist Center to cater for the growing demand regionally. So Raffles Specialist Center, which is previously known as the Raffles Hospital Extension Block, has already commenced operations in late January this year. And this actually provides a scope for Raffles Hospital for refurbishment and upgrading of wards. So we also believe that the strong local demand should continue underpin growth, and as well as that there will be new growth avenues coming from the contracts from MOH, namely the 5-year term PCN scheme, as well as the air border screening contract in Changi. So as mentioned just now, as we look at the investment holdings, last year they actually grew 21%. But do note that Raffles Holland V rental income actually just contributed contributed 1/4 of their results. So in FY18, we are expecting a higher rental income as there will be a full year contribution from this Raffles Holland V. And the two new China hospital projects remains on track to commence operations in the 4th Q of this year for the Raffles Hospital Chongqing and the 4th Q next year for the Shanghai Hospital. So in medium term, we should be seeing some margin pressures coming from the higher staff costs as they ramp up recruitment drive for these two new hospitals. And we also be seeing some startup costs coming from these two new hospitals. So with that, we maintain our accumulate call with a target price of $1.32. Sorry. And let me backtrack a bit. Do note that they actually increased their payout ratio for this year. So the payout ratio for FY17 is actually at 56 as compared to the previous year at 50%. And if you look back to Raffles Med's dividend payout track record, they have been continuously increasing their dividend payout to reward shareholder. So next, we have Q&M Dental. So for Q&M Dental, as you know that in 2016 and 17, they have actually spun off their China operations, namely IDTER, which is their manufacturing segment, and Housing, which is their clinics services side. So this actually this has actually reclassified as their associates from subsidiaries, and they have they have a combined contribution of 27% of the group's adjusted PBT. And for this year, being post deconsolidation, we'll be seeing that gross profit margin should revert to its pre-acquisition levels, pre-acquisition of the two China operations. So we'll be seeing the gross margin should be at around the high 80s or low 90s. And last year, they have actually bite the bullet to dispose one of the bleeding clinic, namely the Q&M Medical Aesthetic and Laser Center. And recently in January, they have just refinanced via multiple bank loans to refinance their 60 million multi-term note. So with a lower interest rate as well as the disposal of an underperforming clinic, this should be able to save them 2 million moving forward. And for FY17, we have been seeing some weakness in their distribution business. So what we think that is that for this year, the new productivity solution grant announced by Singapore government may be able to help to support demand for new dental equipment. As for their core business, which is the clinic side, this year they will embark on an intensive organic growth where they target to open 10 new clinics in each Singapore as well as Malaysia. But we are lukewarm about their expansion strategy in Singapore as we think that the growth momentum may be slow in Singapore, seeing that the market is getting saturated. So with that, we maintain our neutral call with a slightly higher target price of 63 cents. And do note that in FY17, they have actually paid out a special 0.5 cent special dividend to shareholders post the deconsolidation of their China businesses. So next, I would like to pass on to Alvin, who will talk about Y Ventures.
So we downgraded our buy recommendation to neutral with an unchanged target price of 70 cents. Our downgrade is due to a recent price appreciation. There's no change to our fundamental view of the company. Stripping away one-off expenses shown in the slide, the company would have made a profit of around $93,000. So the reason for such weak sales is because of the transition of wholesale sales to online. In financial year 16, 4 million sales came from the lower margin wholesale channel. We estimate this amount to be significantly less in FY17 as the group moves more aggressively to online marketplaces. This transition will lead to higher margin growth in the future. There are several items affecting overall profitability of the firm. Some of the reasons are higher freight and packaging loss costs, higher expenses recognized during FY17 for FY18 projects, such as Fair Ladder, increase in commission and fulfillment in online marketplaces. Such costs will be mitigated as the online sales gain traction. Overall, we remain positive on the outlook of Y Ventures. We expect strong sales growth stemming from its current publisher, contribution from new book principals, launch of the recently secured 20 consumer brand names, and momentum in its own branded products. Just for your info, last Friday, Y Ventures announced a MOU with SingPost for potential collaborations as well. Next, we have Banyan Tree Holdings. Tong will go through.
Hi, morning guys. Hong here. Three results from me. I'll start off with Banyan Tree first. For Banyan Tree, we see an improved outlook across all business segments. So all business segments primarily, they have the hotel investments, which is the segment whereby the revenue from all the hotels that they own. Second one is from property sales, where they actually build resorts and sell. And the third one is from the fee-based segment, where they actually operate Banyan Tree branded resorts for third-party owners. So we see that the outlook across all three segments are actually pretty optimistic. On the results front, you see that the revenue has come in pretty flat, and I think bulk of what was driving the slight increase in the revenue is the 2% increase in hotel investments revenue, and this is mainly driven by Thailand. Thailand, we see that in the 4th Q of last year, RevPAR was a strong increase of 20% in the 4th quarter. So we all may know that the 4th quarter of the previous year, that means the 4th quarter of 1/6, was the first quarter when the Thai king actually passed away. So that quarter was the first quarter whereby Thai tourism actually got a hit, and so may have provided a low base for comparison, which explains why RevPAR is up 20% year on year. But then again, if you look at the previous 3 quarters from 1Q to 3Q, the Thai RevPAR actually grew an average of 9% in the first 9 months as well. So I think even stripping out the effect of the suffering in the tourism from the passing of the Thai king, you see that generally in that country, tourism is actually on the rise. So, and that bodes well for Banyan Tree because more than 60% of their revenue for hotel investments come from their resorts in Thailand. And so moving down the line, I think one other noticeable change in year on year is this other income. This jump is because of the divestment gains from the partnership they signed with Vanke. They disposed of their resorts in China to Vanke and reaped a 39 million gain. So that explains this jump in the other income in FY17. Other than that, I think I'll move on to the operational side of things. In terms of the geographies that Banyan Tree is exposed to, apart from Thailand we mentioned earlier on, Seychelles also saw healthy RevPAR increase. So across key geographies you see that RevPAR increase was actually pretty good. And the only drag I think in FY17 is in Maldives, where there is actually an increase in supply. And so for fourth quarter, the RevPAR for Maldives was down 5%. And so if you look at this 5%, it's actually in fact a moderation from the previous quarters already. From 1Q to 3Q, Maldives, the RevPAR actually got hurt pretty badly from the supply increase. And 1Q to 3Q, the drop actually ranged between 9% to 33%. So the 4Q drop is actually, I would say, a moderation already. But this weakness we think will likely extend into this first quarter 1/8, because as we all know, there's a current state of emergency in the country because of the political turmoil. So 1Q 1/8 you can expect it to be still weak, but I think going forward, because of the tapering in the like for like room supply in the country, you can see that you can expect that the weakness in Maldives will actually start to stabilize and improve over the next few quarters. And one more optimistic viewpoint is that Banyan Tree actually do review the year-on-year forward bookings. So for 4th Q17, they actually reviewed the forward bookings for 1Q18, which is the quarter we are in now. And statistics is that for 1Q18 it's actually 15% higher forward bookings versus 1Q17. And if you look at this improvement in forward booking, for fourth quarter 17 is actually higher than the forward bookings improvements over the last 3 quarters as well. So if you look at 2Q17 and 3Q17, the forward bookings that they reported was actually 9% and -3% respectively. So it's -3% in 2Q and 9% in 3Q. So moving on to 4th Q, you see that it's jumped to 15%. So I would say the outlook has actually turned a little bit more favorable for Banyan Tree. And in terms of the outlook, apart from the expected weakness in 1Q18 in Maldives to continue, I think the outlook is pretty positive, because if you look at the key region for Banyan Tree is actually Thailand, and 1Q17 is the quarter where the tourism in the country was still weak, was still suffering from a bit of overhang from the Thai King passing. So you can expect the low base of comparison in that quarter. So in 1Q18 you can still expect a good growth from the Thai side at least. And going forward, there's also the potential deals that may be announced under the Vanker and the Accor partnerships. All in all, we maintain our accumulate call on this. Our target price is unchanged at 71 cents. Next up is CityDev. CityDev had a fruitful year of successful land banking. I'll touch on that in a while. As for the numbers wise, you see that the revenue is actually pretty flat. Property development sales revenue is down 5%, but we all know that this is a very lumpy segment of their business. But the thing to note for this segment is that for the year, they actually had very strong take-up in Gramercy Park, Venue Residences and Coco Palms. And the strong take-up has actually dwindled their existing inventory down to just 178 units left for sale. So this in CDL terms is actually very little, 178 units. But over the course of the year in FY17, they actually did 4 site acquisitions comprising of en blocs and GLSs, and these 4 sites actually will add up the inventory quantum to a total of about 2,800 units from the 178 I mentioned. So it actually places CDL in a good position to take advantage of the upcycle in the residential home market prices. Some other numbers which are more noticeable, I think if you look at operating profit, is down 13%. Is a much higher drop versus revenue and gross profit. Reason for that is because of lower gains they recorded this in the FY17 versus FY16, because in FY16 they actually had divestments of two big projects, Exchange Tower and Novo 18. So that actually contributed to the other income divestment gains in FY16. And okay, the next thing on the operational front is that in the hotel business for CDL, RevPAR growth was actually 3.2% global RevPAR, and this is in constant currency basis. This is actually an improvement from the previous year. Previous year you had a 2.3% drop. So this year is looking better, is stabilized and rebounding. And a lot of this strength is coming from the improved occupancies and ADRs for their hotels in the US and in Europe. So on the balance sheet front, CDL is having a lowest ever on record net gearing level. It's just 9% net gearing, and this actually will allow them to tap on opportunities locally and abroad. And I think indeed we have already seen them utilizing the strength in their balance sheet for sites in Singapore, and just recently we saw them winning the EC site in Punggol. That one was done at about a 500 plus PSF, and is likely going to be the first EC launch in Singapore that will cross the $1,000 per square foot mark. But that being said, that piece of land is very prime just beside the Punggol MRT, and I think, okay, moving on, the one negative in the results was that if you look at the residential sales overseas, there is a slowdown, especially in China. And we take reference from the Hongleong City Center project, which is their biggest project in China in terms of residential sales so far. And that project sold 348 units last year. It's a slowdown versus the 500 odd units in FY16. But then I think this slowdown is a function of two things. Firstly, we all know about the cooling measures in China now, and then secondly, we can also all expect that after a launch, you can expect momentum to slow down. I think that is very, very common. But that being said, despite having sold less units in FY17, that whole project is already a healthy 86% sold. And sales value in the HLCC so far has already amounted to 3.5 billion RMB. So going forward, I think the outlook will be that a lot of eyes will be on their upcoming launches. The next one will be the Tapestry, the Tampines Avenue 10 site. So we mentioned earlier on they had 4 successful sites acquisitions since 2017. The Tampines Avenue one is one of them, and is due to launch sometime this month. I think the indicative launch price is about 1,003 plus PSF versus the surrounding projects of, I think, closer to 1,001 PSF. So that one will come in March, and South Beach Residences will come in 2Q or 3Q in this year. And so both projects will actually test the mass market and the high-end segments of the buyers. So I think it's good to note the pace of the take-up for these two projects coming on. So all in all, we have an accumulate rating. Our ASPs for the Singapore projects are actually adjusted upwards by 5 to 10% in tandem with our expectation for the movement in the prices for Singapore home prices this year. So with the adjustments and with the rolling forward of our forecast to FY18, our target price increases from 1210 to 1340, and our rating will remain at accumulate. So the last one I will touch on is Bee Land. There is from the key takeaway I think from the results is that there could be a possible relaunch of the Sentosa properties as the market for the high-end segment recovers. I'll touch on this in a while. I'll go through the numbers first. Noticeable number is that revenue dropped 45%, primarily because sale of development properties was down close to 90%. I don't think it's anything to be alarmed about, because we all know that this is a segment of the business which is very, very lumpy. It's just that in FY16 they had 2 projects in Melbourne and Gold Coast which were selling, and because those 2 projects were already mostly sold out, so in FY17 you don't see the contribution coming in anymore. So in this year, what continues to anchor earnings is the recurring rental income of 147 million. I think if you strip out the divestments and the investments this year, we expect the we estimate the recurring income like for like basis this year to have grown about 3%. So okay, moving down, I think okay, I'll touch on this second point. I think in what is an apparent change in the sentiment and in the tone of management in the results is that they have noted an increase in the interest in the high-end property markets. So we all know that they still have 3 Sentosa condominiums which are still held for rental because of the difficult conditions over the last 3 years. So with the uptick in the enquiries and the interest in high-end property, we see that from CDL in the new Futura launch as well, interest is coming back. So with this coming back of interest, there could be a possibility that management would actually relaunch these 3 properties. And our carrying value in our modeling for these 3 properties is actually at a very conservative 1,500 PSF only. This is actually on the lower range of the traded prices for this Sentosa condominiums from 2017. So the range that was traded was between 1,004 and 2,002 for all the condominiums in Sentosa. So I would say estimate is on a conservative range. So any relaunch of these properties at a price level higher than 1,005 will be a catalyst for Hobby. The outlook I think is stable because, like I mentioned, the rental income has been very stable. I think more than 50% of this is contributed from Metropolis, a grade A office in Buona Vista. And we estimate that this year close to 20+% of leases could be expiring, and bulk of these leases were signed 5 years ago when the office rents were not very far from here. So I think to have positive rental reversions for this office block is not unlikely. So currently HBL trades at a 45% discount to NAV. Is one of the biggest discounts amongst the big cap developers, and is lower than the post GFC average for Hobby. So with that, we maintain our accumulate rating. Our target price also remains unchanged. 298 is our target price. Okay, with that, I'll pass on to Jeremy for the recession tracker.
Hi, good morning everyone, Jeremy speaking here. So for my part, we'll just move our attention to the US, covering the money recession tracker, what happened in Feb. So even despite the volatility explosion event that we saw in the first 2 weeks of Feb, based on our recession tracker, we still believe oil remains well. And at least for the long-term uptrend, we believe the equity market in the US still kind of should stay within this upward trajectory. Yeah, so let's dive straight into what the recession tracker is showing right now. So for the benefit of those that haven't been following this recession tracker, basically it consists of 15 indicators covering both market-based data as well as economical data. And what we try to achieve here is actually to see whether the market is reaching its tipping point, whether we are nearing the end of the bull market or seeing the start of a bear market. So you can see here just a summary of the monthly recession tracker. And right now, just want to point your attention to this particular row over here, the VIX index. So what happened in the month of Feb is we saw that VIX explosion event where the VIX index spiked up more than 100% in a single day, causing some market scare during the first 2 weeks of February. And as a result, we can see the VIX index actually spiked to a high of 50, and then subsequently subsided off, currently right now moving back below sub 20 level. But what happens is with that kind of spike in the VIX index, it actually triggered our recession threshold indicator for the VIX index. So back then we were watching for this level at 27.7, and with that kind of volatility explosion event, it has triggered this particular indicator for the recession tracker. But kind of to reassure everyone again, based on the VIX index perspective, when we actually see the first spike above its threshold, the market does not just form its top immediately. It does have to go through a period of normalization for the VIX index and subsequent few more spikes above its normal range before we see the market top. So all in all, I think at least right now we can see the rest of the indicators, out of 15, only one is flashing red. The rest of the 14 are still well within its healthy range. So all in all, right now we don't really see the market forming its all-time high yet. And moving forward, we believe the market should stabilize and continue to move back into the uptrend, and probably revisit its prior all-time high for the S&P 500 as well as your other two major indices in the Dow Jones and your Nasdaq. Some other key highlights over here would be the TED spread, which I'll elaborate more in the following slide, but just to bring our attention that the TED spread has currently break out of its range, a 2-month range, and actually spiking to a new high of 41 basis point. So just go straight into what the VIX index is showing more recently. So here's the chart that depicts the VIX index at the bottom panel and the S&P 500 at the top panel. And you can see over here, the highlighted region over here shows you the anomaly spike that I've been talking about for the past 2 minutes. So this is what happened in the early part of February. We saw the sharp spike in the VIX index, actually taking the VIX index to a high of 50. And then since then, we have seen the VIX index kind of re-normalize back into a more subdued range. So all in all, right now, what it's showing is, at least based on our historical study, back then, the VIX index is trading pretty nicely within its range of 27.7 on the upper threshold side. And on the bottom side of things, it's trading near the euphoria floor at 10. And for the whole of 2017, we actually see a lot of this VIX index complacency trading at the lower end of the range at 10. And ultimately, the massive spike higher into the VIX index, breaking into new heights of 50 more recently. And this by itself is not really unexpected considering how excessively shorts the market are for the VIX index. So from the COT report, we have seen a net speculative position for the VIX index reaching record high for the whole of 2017. And by itself, we actually warned about this explosion event in the VIX index due to the massive short squeeze that is imminent, which happened again in early part of Feb. So that was what we saw. And moving forward, what we want to see is at least for the market to signal to us that it's moving into a period of turmoil. We need to see the VIX index actually moving away from a euphoria floor of 10 to setting up to a new floor at around 16. So our expectation, at least for the VIX, is for the next 3 to 6 more months, it should continue to kind of move within a subdued manner and in a more contained range of around 16 or so. And for it to signal more market panic, I think we have to watch for another 1 or 2 more abnormally spikes above its range of around 30 before the market actually really forms its market top. So I'll just run through some of the case study during your .com and GFC period, and to show you how the VIX index actually moved in line with the S&P 500 and calling for the market top. So here is the .com case study. Again, same thing here, S&P 500 index at the top panel, VIX index at the bottom panel. And you can see over here, since 1993, the VIX index, again, trades pretty nicely within its range. So upper threshold-wise, during that period, it was at 28.3. And again, on the bottom side of things, the euphoria floor was around 10. And subsequently, somewhere in 1997, we saw the anomaly spikes above its normal range of 28.3 during this period here. And you can see over here, these 2 anomaly spikes again, shown by the red rectangular area. We saw the VIX index spike to a high of 50, which is pretty similar to what we saw in the early part of February. So all in all, you can see how the VIX index kind of moved in relative to its price action in the past. And subsequently, what happened is once we got the anomaly spikes, the VIX index then re-rates higher from a euphoria floor of 10 to a new base of around 16. And what happens is you can see after a few more months of rebasing and renormalizing of its new floor of 16, the second retest of the floor actually, the second retest of the floor over here, somewhere around in August, September of year 2000, kind of coincided with the market top. So all in all, we need to see at least a few more things playing out, as right now we are seeing this anomaly spike. We need to see a few more spikes as well as the market rebasing of a new panic floor of around 16 before the market actually forms its market top. Similar picture happened again during your housing boom period of 2000. So somewhere around since 2003, the VIX index again traded pretty nicely around its comfortable range of 23.8 on the upside, as well as a euphoria floor of 10. And subsequently, somewhere around 2007, we saw our first anomaly spike. And then what happened is the market re-rate higher from a euphoria floor of 10 to 16. And ultimately, subsequent two more anomaly spikes kind of confirm that the market is going through a period of panic. And what happened is once we see a retest of the 16th floor for the second time, the market went into a deep sell-off of 50%. So just bring you back to where we are right now. This is the current picture. We believe this is the first anomaly spike that is happening within the market. And like I mentioned again, moving forward, we should expect the VIX index to kind of rebase itself off a new floor of around 16, and to watch out for further anomaly spikes higher to kind of give us further confirmation that the market is really truly going through a period of weakening and probably going into a phase of risk-off mode rather than risk-on mode. So continue to watch this space for the VIX index to see if that kind of a pattern plays out, where we rebase off the floor of 16 and subsequently to see further spikes higher to confirm the market is topping over. As of now, it's not showing, and hence we believe the market should continue to climb higher moving forward for probably at least another 3 to 6 more months before anomaly spikes again in the VIX index happen. Okay, so moving forward, right now, point you guys to some of the more positive data set within the recession tracker. So here is the University of Michigan Consumer Sentiment Index. At the bottom panel, top panel shows the S&P 500 index. So I've shown this a few times before, but for the benefit of those that haven't seen this again, just to illustrate how we use this particular indicator to call for market tops. So there's a very strong positive correlation between the UMich consumer sentiment to the S&P 500 index, and how we kind of pinpoint a market top is to watch out for the UMich consumer sentiment to break below its multi-year uptrend line. So you can see over here, this 2 period in the highlighted area, when the UMich consumer sentiment breaks below its multi-year uptrend line, the market kind of confirms itself that a top is in and an imminent sell-off is just waiting to happen. So it happened somewhere in January of 2001 where we saw this break, coincided with a 38% sell-off. Same one happened in November of 07 where we get the break of this particular multi-year uptrend line corresponding to a 49% sell-off, and right now this is the multi-year uptrend line that we managed to draw since 2011 and it's holding up pretty well. So last month we highlighted that we were reaching a kind of a tipping point when the UMich consumer sentiment is hanging around this particular threshold. But with the most recent data set coming out, we saw it rebounding higher again to a high of around 99.9. So some kind of a sigh of relief here for the UMich consumer sentiment perspective that this threshold continues to hold. So until we see a huge reversal in trend from a consumer sentiment point of view, we believe the equity market as a whole should continue to move higher from here on. And overall, in terms of other consumer sentiment gauges from Conference Board as well as from Bloomberg, both the other measures are showing similar rosy picture as well. And even so, in the industrial side of things, the ISM manufacturing PMI is also showing pretty strong growth. And hence, all in all, in terms of sentiment perspective, right now we are still not seeing any sign of weakening. And based on recession tracker-wise from these 4 indicators, it's still pointing towards higher equity prices moving forward until we see a major reversal in this particular uptrend for the sentiment perspective. And then another good data point to highlight here is the unemployment claims. So basically this one shows you unemployed citizens are filing for food stamp and income support. So right now, I think as of the last update that I gave, the unemployment claim was at a multi-decade low that was lowest in 1973. But right now with the most recent reading, we saw the unemployment claim hitting another new record low of 210,000 on a weekly basis, and this is actually the lowest since 1969. Quite a feat by itself, and again signaling that a strong growth within the unemployment, strong growth within the labor side of things. This corresponds pretty nicely as well with the unemployment rate right now at 4.1%, lowest since 2000. So all in all, in terms of labor market wise, we are still seeing strong growth. But keep in mind how the unemployment claims move within a business cycle, whereby whenever it's near a multi-decade low, somewhere like the range that we are in right now, or like during a .com and GFC period, whereby the low was at 259,000 and 282,000, the unemployment claim tends to move in a mean reversion pattern and go through a period of downtrend to uptrend. And this is again due to business cycle that market is in, and hence right now, as of now, we are not seeing the mean reversion happening, but it's just a matter of time before the unemployment claim actually bottoms out and head into a period of weakening. So all in all, until we see that weakening trend come into the market, we believe the equity market should continue to move higher from here on. And this should actually tie in pretty nicely together with the unemployment rate to give us further confirmation that labor market as a whole is weakening when we see both of the indicators actually reverse higher from the future point moving forward. So as of now, it's not showing. Labor market still remains pretty healthy as of now. This is one of the data set that is showing some kind of deterioration. So TED spread basically measures the interbank rate, whether is there any interbank stress or not. So the higher the TED spread is actually signaling to the market that there is a heightened liquidity risk within the interbank level. And what I want to point out over here is you can see the highlighted region where the 36 basis point was like the range high over here. With the volatility explosion event in the early part of February, it kind of caused some implication on the interbank level, whereby we saw the VIX index actually reacting to the spike in the VIX index. This implication over here, as you can see, the TED spread spiking above its 2 months range, and right now trades at around 41 basis point. So I think the key thing to look out for, at least from a TED spread perspective, is to see whether if this particular spike sustains or not, and if we are going to see a new period of uptrend within the TED spread. So the higher it goes, again, like I mentioned, it will signal to the market that there is a higher interbank risk that's coming on the market. But keep in mind that the key threshold, at least for the TED spread, is the 1% level. So by itself, it's still a far cry away. Right now, we're at 41 basis point. 1% is still quite a distance away. So in order for us to even tag that line properly, it will still require the market a few more months before we hit that 1% level and before it signals to the market that the top is in. So in all, continue to watch this space to see if this upward trend continues or not. Okay, just point you guys to price action on the S&P 500, why we don't think that the recent 12% sell-off in the early part of Feb is the end of this particular bull market. So I'll just run through some of the case study that we've seen during a .com peak as well as your global financial crisis peak. So what we see is that based on our study, the market does not just form an inverted V-shaped top at the end of the bull market. Instead, consolidation and distribution tends to happen at the top first, and seeing correction up to 10% is a norm in a euphoric bull market. So here's the S&P 500 index in the 1990s decade, nearing to the end of it, to highlight what happened just before the peak in the market. So you can see the red arrows over here shows the multiple episodes where the market experienced corrections are up to 10% on a short time span. But the main emphasis again is the market tends to follow and respect a maximum drawdown of around 10 to 15% before the buyers come back into the market. So what I'm mentioned is, you can see here, the first sell-off here took S&P down 11%, but we saw a recovery higher 9% and subsequently another 10% down. But usually when we get this kind of a strong move to the downside, the S&P 500 index tends to rally back up and break its prior record high. So during this period over here, the 20% rally actually brought the S&P 500 index to a new high, and again subsequently another 12% drop here led the S&P 500 index to recover 18% and break into a new high. Ultimately, it's the fourth largest sell-off that came to the market, a 14% sell-off that kind of pinpoint and confirm that the market is going through a period of turmoil, whereby we don't see any more new highs in the market, and ultimately once it recover 14%, some sort of a dead cat bounce. This 14% rally was the last rally that we saw in the market, where the .com peak formed and the start of the bear market. So this was happened again to emphasize, during this period we saw 4 of such large sell-off before the market forms its peak. And same thing again happened in your housing boom period of 2000. So you can see what happened somewhere around in Feb of 2007. We saw our first sell-off. This was pretty small, 6.8%. But considering the previous movement in the S&P 500, 6% is still quite a big move by itself. And what happened is the market recovered 14% again to break in the new record high during this period. And then the second sell-off over here took price down 12%. And you can see the subsequent recovery brought price back up to new record highs again. And ultimately, it was the third sell-off that kind of sparked the end of the bull market. At 8% really rally from its GFC peak and ultimately began the start of this particular bear market. So all in all, the market at least needs at least 4 of such large sell-off or 3 of such sell-off to kind of usher in the start of the bear market. And we believe the current sell-off that we saw, the 12% sell-off that happened in the early part of Feb, is just the first anomaly sell-off that we saw. So for the whole of 2017, the S&P 500 index traded pretty comfortably and didn't really experience a correction up to 5% for the whole year. And we only got such a large sell-off coming in early part of February of 12%. And we believe, again, like I mentioned, the maximum drawdown that the market tends to respect is around 10 to 15%. And hence, you can see this 12% sell-off is kind of halted by strong support at these 2,542 points as well as 200-day moving average. Once the level held up, you can see what happened is the market reversed back into the uptrend, and we believe moving forward, this uptrend should continue to hold intact. And for us to be more convinced that the market is reaching its tipping point and forming the top, we need to see at least two more of such examples, two more of such a large sell-off of probably 10 to 15% before we are more convinced that the market is really signaling that the weakening process is getting stronger. So all in all, I think right now the uptrend has re-engaged itself, at least for the US equity market, based on price action as well as recession tracker. Moving forward in terms of price target wise, we believe the S&P 500 should continue to move back into this uptrend to retest its prior high of around 2,888 points, and possibly even to take out this high and to test for a new record high. Another perspective here from our recession tracker. So here's the S&P 500 index on the monthly time frame chart. Again, definitely we are overdue for a large correction, simply just based on the relative strength index at the bottom panel over here. RSI basically shows you momentum, how overbought or oversold we are. So from our historical study, you can see reading above 70 tells us we are overbought, and the more recent reading over here for the RSI shows we are in an unprecedented kind of a scenario where the RSI hit a high of 88. Put things into context, you can see the RSI in the global financial crisis was at 79, and your dot-com peak was around at 72. Then whenever we are in the overbought territory, it's telling us that we are overdue for a correction. But the key thing to watch for calling for the market top is for the S&P 500 index to actually close below the 10-month moving average, which is the red line. So during both your .com and your GFC period, we saw that kind of a price action coming to play, whereby the bearish close or the close below the 10-month moving average actually signal in the top of the market. So somewhere around in here, you can see once that happens, the bear market kind of accelerated. We saw a 45% sell-off during this period, as well as the GFC era over here, where the close of the S&P 500 below the 10-month moving average caused the start of this bear market of 53%. So the most recent sell-off of 12%, intra-month we did actually tag that particular 10-month moving average. But with the most recent recovery in the last 2 weeks of February, you saw the S&P 500 index actually edging away from the 10-month moving average again. So in terms of us calling for the top, from this perspective, we need to watch at least for the S&P 500 index to close below this red line, which is 10-month moving average at around 2,573 points. So moving forward, I think in terms of price action wise, in terms of recession indicator wise, once one of the indicator triggers its threshold, for example, like this 10-month moving average closing below the red line, I think more of the indicators will also follow suit and trigger its respective threshold. But as of now, it's not showing, which is why we remain kind of a risk on for the equity market as a whole. Yeah, so in summary, what we see is we believe the general strength of the US economy continues to remain steady despite the recent vol shock event. And we expect the general equity market to stabilize moving forward and hit back into the uptrend as our recession tracker continues to remain well within its threshold. So all in all, we remain risk on from price action perspective as well as from economical standpoint. I think the key thing to watch out for, at least from economical standpoint, is we need to see a major reversal in trend for the economical side of things before we are more convinced to call for the end of the bull market. As of now, the economical data as a whole are still showing pretty rosy picture, continued growth within the economy side of things. So which is why we are still kind of bullish for the equity market as a whole, and which is why we are still kind of a risk on from that perspective. Yeah, so for those that haven't been following this recession tracker, would like to know more in depth in how we actually decipher each and every single indicator, you can actually refer to these two links over here where we explain in depth how we analyze them and how we use the indicator to kind of pinpoint the market top. Yeah, and yeah, with that, we've come to the end of today's webinar. We'll pause right now for question if there is any. Thank you. There's a question asking, did the recession tracker pick up the last recession correctly? So definitely in terms of our recession tracker wise, let me just bring you back to the list of indicators that we watch. So not all of the recession tracker or recession indicator that we track kind of a pinpoint that recession that happened in your GFC era, but just to point out a few that has stronger historical study relevance, that is the unemployment rate. This particular indicator over here, the unemployment rate, it has pretty strong predicting power for calling a recession. Our data set goes back all the way to 1950s, and we had 10 of past such example whereby the unemployment rate, they actually kind of pinpointed a market recession prior to the market falling into a recession. So our historical study, at least from an unemployment rate perspective, is once the unemployment rate reverses from a multi-decade low and actually triggers and moves higher away from the 12-month moving average, it usually provides a lag time of around 6 to 10 months before the recession comes into the market. And like I mentioned again, our historical study shows us that there were 10 of such examples since 1950s. So in terms of all of the indicators showing that particular recession, calling for the GFC recession, I wouldn't say all of them have the capability of doing it because some of the data aren't really available back then. But definitely in terms of calling for some, such as my unemployment rate, as well as TED spread, 210 spread, Fed funds rate as well. So Fed funds rate is also one that has very strong correlation power for calling the end of a recession. What it shows is that at every rate hike cycle, a market recession tends to happen. And what I mean by that is whenever the Fed goes through a period of rate hike for at least maybe 3 to 5 years, once the Fed stop with the rate hike cycle and go through a period of easing from a rate hike cycle to a rate cut cycle, usually the start of the rate hike cycle signals the end of the bull market. So again, our historical study for the Fed funds rate goes back all the way to 1940s, and we have probably around 6 to 7 of past examples for that kind of a correlation playing out all the way back to 1950s, 1940s. So all in all, in terms of indicator-wise, we do have some indicators that kind of pinpointed the market top during our GFC period of 2007. So in a way, it's pretty reliable for calling for market top, and especially for watching for seismic shift in the general trend of the market. Okay, there's a question asking, can we say something about the duration of the bear market? So again, our historical study we did some time ago, what happens during a bear market is on average, the bear market usually lasts no longer than 2 years. So for example, like the one that we saw more recently is after 2007. Just bringing you back to the chart that we saw here. So you can see over here during our subprime period, this sell-off here lasted I think less than 2 years. Same thing over here during the dot-com period, the bear market lasted for less than 2 years. And partly it's because of the monetary policy intervention that is being done by the central banks. Usually the bear market didn't last too prolonged. And moving forward, if we actually fall into one of the bear market, seeing a correction up to 50% or so, probably this time out the recession or the correction that's going to come into the market will also be somewhere in the range of around 1.5 years to 2 years.
Hi, Tohong here. There's a question on Hobie and the London properties that they are holding. For that portion of their business, I think it's pretty stable because the leases that the company, the buildings are subject to, they're all on pretty long leases of between 5 to 10%, and the leases are contracted with built-in yearly escalations as well. And as for the exposure to the pound, there's a natural hedge for the purchases of the buildings in London as well, in the sense that the debt that is incurred on these purchases are also in the like for like currencies.
Hi, Jeremy speaking here. So there's another question asking, looking at the overall situation, are we seeing some bearishness coming to the market? So I think by itself, in terms of a cyclical perspective, a long-term perspective, what we are seeing is right now we are in a late-stage economic cycle. And what I mean by that is right now, for this particular economic growth, we are right now in the 104th month of economic expansion. There was a recovery since 2008. And on average, normal business cycle, the normal business recovery expansion only lasts for on average about 60, about 70 months or so. So right now we are definitely moving away from that kind of economic expansion in the late stage economic cycle, whereby recession tends to happen. And just to put things in the context, like the housing boom period, what we saw was that the economic expansion only lasted for around 73 months. Right now we are in 104th month of economic expansion, which puts us in a way likely for a recession. But right now, in terms of what I just mentioned in the past 20 minutes or so, in terms of recession tracker wise, we are still not there yet in terms of calling for the top. Recession tracker still shows that overall health in the economy still remains strong until we see a reversal in the particular trajectory from the upside moving to the downside. I think then we'll call for the market top. As of now, it's not showing. And again, to emphasize again, the economic cycle right now, we are in the third longest economic expansion in history. The longest one happened in the 1990s decade, whereby the economic expansion lasted for 120 months. So you can see over there, I'm not saying that because we are right now in the late stage economic cycle, we will slip into a recession immediately. It still has further runway to go. And that's why we are using the recession tracker to kind of pinpoint exactly when the market might actually form its market top. As of now, like I mentioned again, it's not showing up yet. Hi, there's a question asking, inflation scare was the cause for the recent S&P market sell-off, and will the forthcoming tax cut policy, infrastructure spending, coupled with low unemployment rate trigger the next inflation scare and the start of the bear market? So yeah, definitely the most recent theme has been the rising inflation scare that we are seeing. But more importantly, I think we are still quite a distance away from the Fed target of 2%. Until we reach that level and when it gets out of control, we believe the market should continue to stay fine. In terms of soaring inflation, right now we are not seeing it. And in terms of oil price wise, it's hovering around the 60 range. I think until we see oil price moving higher away from this 60 range, probably into the highs of 65, 70s, then we'll probably see a high inflation number coming to the market. In terms of further policies such as the tax cut and infrastructure spending, definitely that will be plus for inflation coming to the market, as well as the most recent trade tariffs that Trump has told us in the market last Friday, whereby he's going to impose 25% steel tariffs as well as a 10% aluminum tariff on imports. That by itself should also kind of lift inflation as a whole. So moving forward, I think you're right to say that inflation is the key thing to watch out for that will kind of bring in further upside in the market. So in terms of inflation, if it does continue to rise higher, we believe the Fed will have no choice but to increase its interest rate. As of now, the Fed funds rate is expected to be raised 3 times this year. And if inflation do get out of control, probably we'll see a more aggressive rate hike coming to the market. But as a whole, based on our recession tracker wise, like I just said, if the Fed continues to raise its interest rate, I think it shouldn't be a factor for causing the market to turn over, because as they continue to raise their interest rate, is continuing to signal to the market that there's further vote of confidence for the economy side of things. And usually what tips the market over is when they go through a period of rate hikes into a period of inaction. And ultimately, once the Fed moves on to a rate cut, usually the point whereby the rate cut happens is when the market rolls over. So using that perspective, I think watch what the Fed does in terms of their rate hike cycle. I think the moment to worry is when the Fed actually stops its particular rate hike cycle and probably goes into a period of rate cut. The point will be the area to watch out for to signal for further market weakness. Okay, so there's another question asking what would be the range for the reaction time based on our recession tracker. So I'll bring you back again to the summary of the recession tracker. So here's the list of 15 indicators that we have, and we segregate them into 2 different groups. So one group itself is the market-based data, and the other group is the economical-based data. So definitely economical-based data will be lagging because they tend to report data that are 1 or 2 months prior to the particular month itself. And hence that by itself will provide some lag time of probably 2 to 3 months before we find a market top. We use them more for confirmation, and the one that can give us more of a pinpoint accuracy for calling a market top is the market-based data. So market-based data based on our indicators are things like your TED spread, 210 spread, 10-year Treasury yield, VIX index, S&P 500, and your value line geometric index. So we look more in terms of the market-based data to give us what is really happening on the ground on a day-to-day basis. And once it triggers its threshold, usually a few months later, we will see confirmation from the economical data perspective, from our Fed funds rate, consumer confidence, PMI, unemployment rate, as well as retail sales. So all in all, in terms of us calling for a top, we will definitely get some action from the market-based data first. So for instance, what is happening right now is VIX index is the first one to trigger its threshold. And we are seeing some repercussion coming into the market from the TED spread space, whereby it's recently breaking out of a new range. So you can see the feedback loop coming to the market, whereby we are seeing some kind of a weakening, different environment from what we saw in 2017. So things are changing definitely, and I think moving forward, once we see more market-based data triggering its threshold, I think further confirmation is needed from the economical data perspective. Okay, since there are no more questions, we'll end today's webinar here. Thank you very much for tuning in, and we hope to see you guys again next week. For more of our reports, just head to stocksbnb.com. Thank you.